Double candlestick patterns are essential tools in price action trading because they provide early signals of potential market reversals or continuations, often before indicators respond. By analyzing the interaction between just two candles, traders can gauge a sudden shift in momentum between buyers and sellers. These patterns become even more powerful when they appear at key technical areas such as support, resistance, trend lines, or supply and demand zones. In this video, we're going to talk about double candlestick patterns. How to interpret market psychology through a double candles. We'll explore the main types of double candlestick patterns, both bullish and bearish. And finally, we'll walk through real chart examples for each pattern, showing you exactly how to trade each pattern in live market conditions. If that's something you're interested in, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. Double candlestick patterns are technical price action formations, composed of two consecutive candlesticks on a chart, that together indicate a potential reversal or continuation in market direction. Each double candlestick pattern is a visual representation of market psychology. The first candle shows the dominant side, and the second candle often signals a shift in momentum. Let's now understand double candlestick patterns one by one. Beginning with the bullish engulfing pattern, this pattern occurs when a small bearish candle is immediately followed by a larger bullish candle that completely engulfs the body of the previous one. When it appears at the end of a downtrend, suggesting that selling pressure is weakening and buyers are stepping in aggressively. The strong bullish candle signals a potential bullish reversal, indicating that the momentum may now favor the bulls. Traders often see this as a signal to look for long opportunities, especially when it forms near a key support zone or after a sharp decline. Next, we have the bearish engulfing pattern. This pattern is the opposite of the bullish engulfing. It forms when a small bullish candle is followed by a larger bearish candle that completely engulfs the body of the previous candle. When it appears at the top of an uptrend, signaling that buying momentum is fading and sellers are stepping in with strength. The dominance of the bearish candle reflects a potential bearish reversal, often leading to a downward move in price. Traders look for this pattern near resistance levels or after a prolonged rally to anticipate a possible trend reversal to the downside. Moving on, let's talk about the bullish Harami. This pattern forms when a large bearish candle is followed by a smaller bullish candle that is completely contained within the body of the previous candle. Typically, there is a visible gap between the closing price of the bearish candle and the opening price of the bullish candle. The term Harami means pregnant in Japanese, which reflects the visual. The second candle appears to be inside the first. This formation is weak reversal signal, as selling momentum weakens and buyers begin to step in. While it's not as aggressive as the bullish engulfing, it still signals a possible shift to the upside, especially when it appears at key support zones. Next is the bearish Harami pattern. Here, a large bullish candle is followed by a smaller bearish candle, which stays completely within the body of the first one. This pattern indicates weak bearish reversal and growing hesitation among buyers. When the bearish Harami forms near a key resistance level, it suggests that buyer strength is beginning to weaken and that sellers may be gaining control. This makes it a potential early warning sign of a trend reversal from bullish to bearish. Now let's look at tweezer patterns. Tweezer top forms when two consecutive candles appear with nearly the same highs, but with opposing directions. The first candle is bullish, indicating continued upward momentum, followed by a bearish candle of similar height that signals a potential bearish reversal in the market. This pattern is considered most reliable when it appears after an extended uptrend or near a key resistance level, as it signals that the uptrend may be weakening and a downward reversal could be imminent. Conversely, tweezer bottom forms when two consecutive candles appear with nearly identical lows and similar height, but with opposing directions. The first candle is bearish, showing continued selling pressure, while the second candle is bullish, signals a potential bullish reversal in the market. This pattern becomes especially significant when it appears at a key support level or after a sustained downtrend. The matching lows indicate that the market found strong buying interest at that price level, rejecting further downside. Next we have the dark cloud cover. This pattern forms when a bullish candle is followed by a bearish candle, but with two critical characteristics that validate the setup. First, there must be a gap up between the closing price of the bullish candle and the opening price of the bearish candle, indicating initial bullish enthusiasm. Second, the bearish candle must close below the midpoint of the previous bullish candle, signals a potential bearish reversal, especially when it appears near a resistance level or after a strong uptrend. On the opposite side, we have the piercing pattern. It forms when a bearish candle is followed by a bullish candle, but with two key conditions. First, there must be a downward gap between the closing price of the bearish candle and the opening price of the bullish candle, showing that sellers initially pushed the market lower. Second, the bullish candle must close above the midpoint of the previous bearish candle, signals a potential bullish reversal, when appears at key support zone or at the end of a downtrend. Now let's walk through some real chart examples for double candlestick patterns, and see how these setups work in actual market conditions. In the first example, the price has recently identified a resistance zone. As the market pulls back to retest this area, a bearish engulfing pattern appears. The closing price of the large bearish candle is a valid entry point for a sell position. Set your stop loss just above the high of the bearish engulfing pattern. This helps limit risk while giving the trade enough room to breathe. Aim for a take-profit target near the next support zone, an area where buyers may potentially re-enter the market. In the next example, we can see the price retested a well-defined horizontal resistance. At this point a bearish Harami pattern forms. This signals buyer exhaustion and a potential momentum shift to the downside. Enter a short trade after the bearish candle of the Harami closes. Place your stop loss just above the high of the bullish candle and for take profit, target the next support level. In this example the market is in a downtrend. As price approaches the trend line once again, we observe the formation of a tweezer top pattern. This pattern indicates that buying momentum is weakening at an identified trend line. A potential sell position can be taken once the tweezer top pattern is confirmed. Place your stop loss just above the high of the tweezer top. Set your take profit target near the next significant support level, where the price is likely to find buying interest again. Let's move to the next example. We observe that the price has pulled back to a key support zone, an area where buyers have previously shown strong interest. At this level, a piercing line pattern forms. This suggests that buying pressure is returning, and the sellers are losing momentum. A buy position can be considered once the piercing line pattern is confirmed, typically at the close of the bullish candle. Place your stop loss just below the low of the piercing pattern. For the take profit target, aim for the next resistance level, where the price is likely to encounter selling pressure again. Remember, double candlestick patterns work best when the second candle shows a strong body and clear momentum shift. Weak or indecisive second candles often lead to false signals, so always look for strong confirmation in size and direction. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.